You look back and you're like, stock market, while it may react in a little blip of time to a war that is happening, stock market doesn't actually care.
I mean, does it really care about much?
So people are not getting paid more on an annual basis and their wages not increasing. Plus there's also the added risk of being unemployed. Those signals then get closer to trending to a recession.
So we are watching. People that I know are not living paycheck to paycheck are just up in arms about gas prices.
And have you seen the price of eggs?
I get it, but like, it's kind of normal. Like, people flip out to me and I'm like, I'm still driving as much. I'm still going to the gas station. Like, It's not dinner table conversation to me.
Over the past 25 years, if you missed 40 of the best days, your $1,000 is now $670.
So you lost money.
Yeah.
That sucks.
And it was 40 days out of 25 years.
That's insane.
You sounded like you were about to cry.
I know. I care. I think seeing these charts too, when you see it come across your desk and you see it with a real human, like, that's why I'm like, dun dun dun!
Shut up.
Matt, don't use that.
If you're a visual learner, today's episode is for you because we are talking about charts. Welcome back to another episode of Playbook of the Wealthy. My name is Dave Grant. My co-host is Heather Townsend. And today we are talking about charts and the awesome things that we can tell you about them. So let's dive in.
Wait, can I give our listeners some, like, why do we do these chart episodes? Because we're nerds. I mean, besides that, but I want to say that
I like pictures.
We like pictures. I think people are visual learners.
Yes.
If you are listening to this in your car, we will try to do our best, but it's probably better.
That's going to be a hard episode.
Yes. But really, we picked out charts that it's not just, oh, these are charts you're just going to learn. It's about things that are happening in the economy or going on today. And we don't want you to just, oh, Heather and Dave are just saying whatever they want. No. There is data and charts that prove it. And that's why we want to go through it. Keep you educated.
So before we jump in, shout out to JP Morgan. They release all their charts quarterly, and Clearonomics, which is Standard & Poor's. We pull the charts from here, so thank you very much. Slide number 1. All right, we're talking about the stock market. I have got a lot of questions about, is the war in Iran, whether it is ongoing, stopped for a period of time, picked up again, how is that affecting my investments? Valid question. Historically, you look back and you're like, stock market, while it may react in a little blip of time to a war that is happening, stock market doesn't actually care.
I mean, does it really care about much? I mean, you have to have a lot of fear. It reacts when there's fear. The war goes on. Then the war stops, and what happens? That's what I feel like these charts show me.
Yeah, there is so much going on that a war is just like a blip in another blip of things going on.
And I'm not trying to say, okay, wars are serious. I don't want anyone to mistake what we're saying, but we're just talking about investments. So volatile, yes. Sometimes a flat period, I would say, and then it just goes after the war. So there's two charts we're showing you. The S&P since 1900, it actually breaks out when the wars have been in history. And what I saw is like kind of flat during the war, more like volatile, but it kind of flat. You're not really making returns. And then it just goes afterwards. This other interesting chart that we find is it actually started showing by each war in the US what the returns were in the S&P 1 year, 5 years, 10 years. And I'm guessing it's the start of it was this chart. Yeah. So like global war, nothing in the first year. So this aligns with what I'm saying.
Talking about World War I. No, World War II.
Oh, yeah. World War II. Then 65%, 5 years. And then 155% it returned in totality. I'm imagining that's not in 1 year.
Sure.
But in totality of those 10 years. So, and then you go to the Iraq War in 2003, 31% in the first year. 52% 5 years, 55% 10 years. I'm just picking top to bottom. There's crazier numbers in here. The only one is Vietnam War, which was just kind of it was flat.
Yeah. I mean, there was quite a few recessions. If you look at the other chart during the Vietnam War, those gray bars are a period of recession. And if it's a thicker gray bar, that's going to be how long the recession lasted. And there were a number in the Vietnam War. And it was in the 70s and 80s. That's when interest rates were sky high, kind of hard for the stock market to really do its job effectively.
Stagflation. Yeah.
Yeah. So that is not a victim of war, so to speak, but I think a lot of other economic factors going on.
Yeah. So I think why we just want to show you this on takeaway is we've said this before, but I want to always be reminding everyone, news is always scarier. Fear is what gets people to pay attention to, so they're going to use it. I am not saying war isn't scary, great, none of that. I am just saying the stock market typically doesn't react very much to it, or it will, and then it goes crazy afterwards.
Mm-hmm. So leave your investments alone.
Yeah, do not
Take
sell.
your hands off.
Yeah.
Chart number 2. All right, we're talking about labor market dynamics.
This chart.
Nerd alert.
I know this one.
Jeez. Nerd alert. Nerd alert. All right, so let's take you through these two charts.
That was a really, can you do that going forward and anytime we get nerdy? Because that would have been my favorite one of yours.
I'm going to have to do that a lot.
Yeah,
Yes.
okay.
All right, so let's look at this chart on the left. Non-farm roll payroll gains. Again, nerdy. All right, to put that into context, a non-farm payroll gain, that is business and government.
Yeah, you're not farming. Let's just keep this simple. You're not on the farm.
So we're looking from 2021 over to 2026. It is a downtrend from that period of time.
So payroll is not increasing. Like, are you saying wages aren't increasing, or like the amount of employees on payroll isn't increasing?
So it's going to be the payroll gain with how many people are employed and being paid is slowly decreasing.
Okay.
Or the rate of change is decreasing.
Yes.
So we're not growing the wage base, so
Okay.
to speak. And it's trending into the negatives too. You know, it popped up in 2026, but that's not a trend you really want to see. It's just going to kind of lead you to a recessionary economy, one that is not hiring, one that's just becoming stagnant, and it's not really helping people accelerate their career. Well, you flip that over to that second chart, and that kind of confirms it. You know, we're looking at unemployment rate and annual wage growth. Well, since 2021, unemployment has slowly been ticking up to where it's going to hit
5%.
Yeah, so 5.5% is the average over 30 years. We're getting closer to the average. So we're at 4.4% in February of 2026, trending in the wrong direction, essentially. But you also do want to have some unemployment. If you are fully employed in the workforce, it's actually a bad thing.
Because then you don't have as much, you don't have talent. That was the COVID problem. You didn't have talent to call upon.
Yeah.
Or use.
And that's where people jump jobs and really increase their wage base, essentially.
It's trending up, but I still wanted to bring, which surprised me with all this AI fear going on, we still have not gone above the 30-year average of unemployment. But you'd swear by all this fear doom that we are, but we're not. It's just trending up, and wage growth is down.
And that's continually trending down. So people are not getting paid more on an annual basis, and their wage is not increasing. Plus, there's also the added risk of being unemployed, which those signals then get closer to trending to a recession.
So we are watching. Just watch.
Well, that then feeds into number 3, because if we then get closer to a recession, the Fed's mandate is to control unemployment as one of their mandates and control interest rates. And
inflation.
Yes.
They use interest rates to keep inflation where they want it, which I think is their target 2.2 or something like that. Is around 2%. I know that.
I mean, interest rates have been wild. Like if you go back to 1993, this is where you're talking about going from 6% down to 1, back up to 6, then you hit 8. Yeah, we were at 0 for a long, long time.
Which people are like, I don't remember 0. This is the Fed's fund rate, and then the banks add on, or whoever add on the rate if you're lending on top of that.
Yeah.
You make money. So it's not, don't take this as mortgage interest rates that we're talking about. It's the Fed fund rate.
Exactly, not tied together. So one thing that is interesting to look at, since 2023, we've been trending downwards. When you go back to the previous slide, which says, well, are we trending closer to a recession? When you get to a recession, the Fed typically cuts interest rates to funnel growth or fuel growth, which then means, well, if people are expecting interest rates to kind of flatline for a while, they might not. They may trend downwards.
Well, it's interesting because inflation, especially with energy and all of that, that's been, we've not been on our target. The last I heard, whenever this airs, I don't know. So I always want to be careful, but we're not near our 2% yet.
Right.
And so, but unemployment is trending up. So the reserve is going to be in a tight spot. Like, which way do I go? Because you don't want to let inflation go too far, but you also you need corporations to be able to have money to hire. So it's very interesting.
It is.
But it's trending, right now it's flat.
It is. Like they were predicting a lot of cuts, and then it pretty much just, there haven't been cuts recently in the volume that they were saying.
All right, you're having fun over here. You're going to tell people.
Well, I think when people see this chart, they're like, well, what do I even do? Like, what's my action point? Well, if you kind of take that big picture and say, okay, if interest rates are high, what do you do? Well, you lock in your savings, like a CD that you could lock in for a period of time, and you lock in that high rate as best you can. If interest rates are low, that's when you flip the script and say, well, let's look at my debt. Can I refinance that, which a lot of people did with mortgages? And how can I get my debt at the lowest interest rate possible? So it's, right now we're kind of in that midpoint. Like we're in that 3 to 4% Fed funds rates, which you can see in high yield savings rates. So kind of you're in that midpoint of, well, there's some stuff you may do, but right now we're not either high nor low.
Yeah, that's why it's like kind of meh. Yeah, just TBD, paying attention. Okay. Oh, this inflation chart going to this is fascinating to me. It did take me a minute where Dave and I had to like walk through this to be like, what is this chart? There's a lot of color.
This is like a kindergarten classroom, just like dropped all the crayons and kids went nuts.
But there are interesting facts here that we pulled out that were like, this is really good for our listeners to hear. So let's just give our 2 highlights from this chart of the colors.
Okay. Look at the green.
That's energy. Green is energy. So like gas. Go into the gas tank. Oh yeah, this is going to be, we're going to go on a little tangent on this one.
So a lot of this will be gas prices, but also fuel for your home. If you're looking at green, let's go back to January 2018. Yes, it made up some of inflation. Going into 20 and 21, it was negative. So it actually didn't go into fueling inflation. It actually took away from inflation and other things contributed to it. Well, flip forward into 2022. That is when energy really took off.
So it's at the top of the mountain.
Yeah, I mean, this was, by percentage standards, this was the lion's share of what inflation was really being fueled by. And that's what people felt. Like that was the 9% inflation period. And it was terrible. Well, look at it drop off. Now it's not even visible really. In 25 and 26, energy prices and the adjustment of prices are not factoring into the inflation numbers today.
So basically, energy is wildly all over the place. Can be negative, can be the highest. It's volatile, kind of like Bitcoin.
Sure. Well, then on the flip side, you look at shelter. Shelter is always there.
And blue and kind of steady and takes up the same amount of space in the chart. It's steady. Yeah.
So your rent or your mortgage payment, that's going to be there. It's always part of inflation. Typically more rent going into inflation. It's always constant and it's always increasing if you're looking at the rate of change of inflation. So rents will continue to go up. Sometimes they go up more in some environments, but it's always going to be there.
Yeah. So I think our takeaway was, now with knowing that energy spikes a lot, just understand that. It's just like understanding the stock market. Okay, it's not going to go up 10% evenly every year. It's going to be volatile. Energy is going to be volatile. Look, I'm not talking about the people that are living paycheck to paycheck here. That is a different conversation. But I think it is funny when my friends and people that I know are not living paycheck to paycheck are just up in arms about gas prices.
And have you seen the price of eggs? That was the other conversation.
Yes. And like, okay, great. I get it. But like, it's kind of normal. Like people flip out to me and I'm like, I'm still driving as much. I'm still going to the gas station. Like it's not dinner table conversation to me. I'm very used to this. Okay. 1 week my gas is $70 and 1 week is $90. I get it. I am not living paycheck to paycheck. That is not who I'm talking about. I'm talking about the people that literally are so upset about gas prices that they spent $20 more which I'm sure that they spend $20 more in their discretionary spending on stuff that does not bring them happiness, that was a waste. I'm sure they have $20 of subscriptions that they don't even know they're using. But gas is $20 more that week, and they are up in arms. Why?
Do I need to hold you back from like breaking through the screen here? Like,
No, but it's normal. Why?
Yeah.
My husband has to go to Costco gas. Maybe it's because it's in my household. He has to go to Costco gas. It might cost more to drive to the Costco gas station than he saves down the road, but he has to go to Costco gas.
That's true.
What is with it in gas prices? And it's volatile.
It is. It's all over the place.
It's all over the place, and it's the one thing that people are very emotional about. I guess if you are one of those people, it's going to keep happening based on this chart. So it's going to be all over the place. Just accept it and move on.
Find something more interesting to talk about.
Yeah. Okay.
Chart number 5. This is a chart that we have seen a lot. We will keep talking about this until we pass away and our grandchildren are just saying, thank goodness that grandpa and grandma just stopped talking about this chart. So this is talking about missing the best days of the market if you started with $1,000.
For the past 25 years.
Yes.
So if you missed this many number of days, how did that hurt your returns in the past 25 days? Okay, go.
All right. So if over the past 25 years, if you missed 40 of the best days, your $1,000 is now $670.
So you lost money.
Yeah.
That sucks.
And it was 40 days out of 25 years.
Like That's insane.
So,
like, I don't even think I realized, like, I knew it mattered, but I didn't know it mattered to that extent that it comes down to 40 days.
It's bizarre. If you left your money alone, your $1,000 was $6,000.
So you 6x'd.
Isn't it wild to think that someone, if they're lazy, they make more money than someone who's actively trying to get in and out of the stock market?
I mean, that's already been proven with active versus passive. I mean, we could go on this, but this chart just proves it. That's why I think also when people say, when you're going to invest, just invest and always invest for the long term with that mindset.
Yeah.
Because then it's much easier to make sure you can capture those good days. The waiting to time the market, I mean, I can even think back in Arizona when I moved there in 2018, and this business owner I was sitting across with, he wasn't a client, he was a friend, but he was like, yeah, we're waiting for the next downturn in Arizona. That was 2018. Arizona is one of the most expensive, like real estate is insane there now. Like the appreciation in Arizona since 2018 is like, waiting on the sidelines is not a good idea.
That's what I'm waiting for.
You are?
Yeah. To buy my retirement house, I'm just waiting. I'll be 80 and I'll still be waiting, apparently. Next chart.
Wait, okay, last one though. I thought this was crazy. Even if you miss 5 of the best days, it's basically like half of if you kept it fully invested.
5 days in 25 years.
Like,
wow.
Now I kind of want to go back in the S&P chart and find out when those 5 best days is. I mean, I guess that's like where AI might be really helpful, but it is fascinating. It's just, I guess the takeaway on this that I really want to just let our listeners know is like, just invest, let it go. You never know when the best day is happening. And if you miss it, it's extremely costly.
It is.
All right.
Slide 6. All right, we're looking at global equity markets. So this is looking at what happened in 2025, so far 2026, and over the last 15 years. Cliff notes, get and stay diversified.
I know, and I'm giggling, and everyone's like, Heather, why are you giggling? The country that produced the best returns for the last 15 years is Dave and I were both surprised at. Listeners, will give you a pause. Can you guess what it is? Do you know? It's like Jeopardy. Is Jeopardy the one where you have to yell out and guess what the answer is?
They probably already buzzed in because they're looking at the chart as we're talking about it. And they've all said Taiwan. So Taiwan has done better than the US S&P 500 over the last 15 years.
Crazy.
However, that is probably wildly volatile, with Taiwan being a international / developing economy.
I'm such a nerd. I go, give me that standard deviation on this Taiwan stuff.
Oh, you nerd.
Nerd alert. Nerd alert.
I mean, if you look at it, they've done 40% in the last year and 9% year to date. As of print, this was at the end of March. So it's been going on a tear recently. Who knows what it has done over the last 15 years. But it's bizarre. Like Taiwan, 2025 was 100% return in 1 year.
That is insane. That is a volatile.
Did I say Taiwan? I meant Korea.
Yo, you did Korea?
Yeah, 100% return in 2025.
Yeah, no, you said Taiwan. So yes,
Okay.
Korea. That is insane though. I don't even know, have we, as the US, ever had 100% return? I'd have to go look. Maybe the Depression. But wow. Wow.
So when I have people who have said, okay, but the stock market in the United States, we did, random numbers, 25%, 20%, and then 15% over the last 3 years. Like, that's great, but can you guarantee that for the next 5 years? Of course you can't. So you have to be diversified. Even if prior history has shown that we can have great returns in this country, who knows when it's going to turn? And who knows if you even missed out? Because if you focused on the US, if you were picking one country to go on, well, you picked wrong. You should have picked Taiwan.
Typically, like the US and international flip-flops, right? Like the US does well for a while and then it flip-flops, and that's when international starts doing well over US. So in the last 15 years, the US has dominated, except for 2025, where you and I got really excited. 2026 is still to be determined. So stay diversified.
And if you're investing in India, your turn will come. Slide number 7.
Global real estate.
This one is colorful and it looks like it's wild, but when you're looking at investing in real estate, you're looking at 2 pieces of the return. So one is going to come from the income that it generates, and the other is based on how it grows. So if you're looking at this, you're looking at from 2009, and this is looking at real estate funds. So you're getting your investment return consistently over time through the income that those funds are kicking off.
Which I would think of, for our listeners, think of like the dividends it's spitting off, right? Is that the best way to think of it? Like these are true dividends. It's profit of your investment. It's after they paid all their expenses for the real estate.
Yeah. And this is driven by trends in real estate.
Yeah.
So this is indicative of the real estate market, but this is what they're just showing you what happens in funds. So your income is going to be a consistent part of that return. But if you're thinking it's going to be consistent year after year, it's really not. If you're down in 2009 and 2010, you had consistently negative capital appreciation.
Well, no. But income is consistent.
Yeah.
Income is consistent. It's about 5%. We didn't say that. It pretty much hovers at 5%.
Correct.
So if you have $100,000, you're going to get consistently $5,000 a year.
Yeah.
Okay.
All the while you're in 2009 and 2010, your investment dropped 20%, 25%, and then another 25%. So your $100,000 is what? 25 grand? 5%. I'm not writing home about that at that point. But then you've got years where capital appreciation is really taken off.
21, 22.
Yeah. So in the early 20s, 21 and 23, 22, you're up the 20%. But then you're down the years after that. Real estate is wild. It's very volatile.
On the capital appreciation, like income isn't. Income's pretty stable. It goes back to our inflation. It even matches with our inflation chart, where it's like housing is stable, inflation pretty much. Same with rental income. But it's the value of the asset that's wild, like moves up and down. And I loved what you said when we were reviewing this chart. Buy low, sell high.
Pretty much, yeah. If you're trying to time the market, you actually can do in real estate, because when there's a drop in the market and it bottoms out and everyone is getting rid of it, then you're like Warren Buffett. Everyone's fearful. Well, I'm going to be greedy.
Yeah.
So you buy up as much as you can, and when everyone is selling at sky-high rates, you probably should too.
Yeah, so true.
Slide number 8. Let's talk about gold.
Oh, gold has been talked about so much because, 2025 was a heck of a year for gold.
It was. That's that bottom left chart with that green and gray chart where you're looking at, okay, it's kind of okay when you're looking at the value of gold, and then you get to 2016 and that $1,500 of nominal and inflation adjusted value of the gold shot up to be $5,000. So it took off. But then you kind of look over to that bar chart that's on that far right, and you're like, okay, well, what if we annualize this? Because 1 year of performance, that doesn't say much. Well, gold, you're going to get returns that are similar to US bonds. It's roughly 5% a year. Look at the volatility. Those returns are going to swing wildly, and gold is way up there, even more volatile than the S&P 500.
Which, when I saw that, I wanted to take this to our listeners, because you go, oh, okay, well, gold produces maybe a little bit better. And I would say it now produces better. I want to also say this. It now produces or gives a better return than bonds because of the biggest increase that it had in 2025.
For sure.
I ran this in 2023 and 2024 because I was considering adding a little gold into my fixed income. And I was like, why bother? It's done worse than bonds. Like,
sure.
Now, because of the 2025 returns, it's actually when you take that in, it's doing better than bonds. But then you go to the volatility piece, and what is the reason that we use bonds? It's not for the returns. It's for the stabilizing of the portfolio.
Exactly.
And you're telling me it's more volatile than the S&P 500? Like, no.
Right.
Just, okay, I'm done. That's mic drop.
No.
Yes. I mean, that's why I love the charts, though, because it just shows it in this beautiful way where it puts it together. Just, okay, nope. Literally how I'm reading this, like, great decision made.
I think the only time that I have people that I encourage them to invest in gold is for like tchotchkes and just keepsakes. Put them in the safe at home and then be like, oh, this is a cool coin. If you're looking to invest in gold, buy different funds, buy some gold miners ETFs, it doesn't make any sense at all. Chart number 9. This is the one that we looked at it. We then understood what it meant and we got a little giddy. So this is looking at capital gains. It's looking at it per different investments. And so you've got it broken down by 4. So you've got passive and active ETFs, and you've got passive and active mutual funds.
And passive is like you're just the index, you're just the S&P. Active is someone is trying to outperform the market. Okay.
This is not looking at if you're selling this asset. This is looking at how do the capital gains in this vehicle, how are they generated year by year just by that fund operating the way it does. Let's look at 2020 just as one. A passive ETF barely triggered any capital gains. An active ETF, it should do. It's actively trading stocks and companies inside of itself.
Selling stock, recognizing capital gains within it. Okay, makes sense.
So it will probably generate a little bit more. ETFs by themselves are typically designed where they don't generate capital gains to be passed on to the investor. That's how they're designed. A passive mutual fund. This was surprising. How much more in capital gains it generates than a passive ETF that could be doing the exact same thing.
Yep.
Just by the design of the investment, the mutual fund, it was kicking off, say in 2020, it's kicking off 4 times or 4x the amount of capital gains than the ETF does.
People are like, why does this matter? We're going to tell you.
Active mutual funds. Every single year.
Like, Scott, like by a big proportion, it's the lime green. Like that is, and I mean, people don't like paying taxes. That's just normally what comes across my desk. And so I'll just tell you this in a nutshell. You have active mutual funds, you have huge tax drag. You are paying taxes on gains you're not even recognizing.
You haven't done anything with the fund.
No,
you've held it.
You've held it and it's spitting off capital gains and you're recognizing income on your tax return that you have not received yet because it's buying and selling stock within the active mutual fund, even though you're not, and it's pushing it out to you. This, I mean, go back to my tax season example. This is what was happening to that retiree that I told the story about. And me just switching from yucky passive mutual funds. They weren't active from the top of my head.
Right.
Just going to passive ETFs. What a change. I mean, I do use active ETFs for bonds and then passive ETFs for stock. So I'm kind of a blend of this, but I don't use mutual funds.
No.
Except a money market fund.
I don't think I've touched an active mutual fund in my career where I had the choice of the investments. When I worked for a firm, I didn't have the choice. So they were in there. But now I don't see why anyone would want to use an active mutual fund from a tax perspective.
No, it's horrible. It hurts your returns so much. And I mean, if you're a retiree in that case, I mean, one time the retiree, when I saw that tax return, their capital gain distributions, put them in the IRMA range. They got their Medicare premiums became more because the income they had to recognize without selling anything put them in that position. Like it's multiple. It's not only paying tax, now you're paying more premiums on your Medicare. Like it's a multiple domino effect.
It's wild.
Like I can give you real examples. So if you're still having active mutual funds, the thing I'd want to tell you is like, please have your investments reviewed or change something with a professional. Probably just switching, if you use a good professional fee only fiduciary, just switching is going to probably pay for the advice in itself from the tax savings. Like just don't. Just don't. Okay. I know.
Sounded like you were about to cry.
I know. I care. All right. Well, because I think it's real. I think seeing these charts too, when you see it come across your desk and you see it with a real human, like that's why I'm like, if other people are listening and this is you, like, please pay attention. Like I really, whatever. All right. HT Bow. I'll go. Here I go. Inflation. Calm down. Housing is stable. That's what you need. Energy, it's always volatile. It's going to change. Your gas is one day going to be $10 more than it was the week prior. If unemployment goes up, interest rates will probably go down, which will have triggering effects. TBD, we're watching, but hey, maybe you get to refinance your mortgage. All right. War is hard, definitely, but it typically spikes afterwards in the stock market, so hang tight.
Or bad, returns good.
Thank you. He said that when we were like reviewing our, like, oh God, I just think it's funny. All right. Remember, don't miss the best days in the stock market. Don't wait to invest. It can cut your returns hugely. All right. Diversify among countries. Gold is volatile. Not worth it. Global real estate. Buy low, sell high. Isn't that how you said it?
Yes.
And I think we've all got it from Heather's little rant, but no on active mutual funds. Please just no. Da-da-da!
All done.
All right.
All right, we're moving into the highlights section of our podcast. This is where you get to know personal stuff about us, even if you didn't want to. All right. Strangely enough, it took us about a year to realize we have the same taste in music, which is house music. I actually get recommendations from TikTok because the artists release like videos of their teaser music coming up. And one I found was Mismo. I never heard of him before.
You heard it. You sent me Mismo. I listened to it.
Yeah. I liked it that much.
Okay. I liked it a lot. It didn't have enough, like, it's more like the chill. It's not the big, deep, like it doesn't have the, you know.
It's very much a chill house recommendation.
Yeah, chill house.
So that is something that I always look out for. So Mismo is someone I would recommend if you're into chill house music. If you don't like it, my wife and both my sons, you'll hate it.
I love
That's pretty much all I got.
My highlight is after this, I'm flying to New York to go to a woman advisor conference at the Metropolitan Club. I will know no one.
Fancy.
I know. But I'm excited. I've been wanting to get into rooms where women are ahead of me, and I'm really excited to see what I learn and who I meet. So I'm really looking forward to that. And I'm going to another new conference. There is I think it's called the Tax Wealth Innovation Conference. People think we're nerds if they even read this guy's stuff. Nerd alert. Nerd alert.
Yeah.
So point being, it's going to be a ridiculously nerdy conference. This isn't just like, oh, active mutual funds. This is like products that are on the market and like how do they work and whatever, and all these nerds on tax and investments. But it's the first one they're ever doing, and I'm really excited to go and learn, because I think you probably know this, after going to all these investment conferences, they start to become the same conversations and the same stuff. And so I'm going to these conferences that I have no idea what to expect, but I feel like it will be completely different to what I've seen.
That sounds a lot of fun.
I expect that there will be some podcast episode ideas coming out after these conferences.
Sure.
Yeah. So I'll let you know how it goes, but that is my next quarter.
Awesome.
2 new conferences I've never been to.
That's way to get out of your box.
Yeah, thank you.
All right, thank you for listening to this episode of Playbook of the Wealthy. If you want to keep listening to us on audio platforms, we're everywhere you can find us on the audio podcast side. Video-wise, we are at YouTube, Instagram, Spotify, and now Apple Podcasts, seeing as they just released their video platform. Go to our website, playbookotw.com, and then you can send us an email, which is at hello@playbookotw.com, and we'll see you next time.
And I really like when you send in your questions. We do answer them, so please send them in. And now I will say toodles.
Nerd alert. Nerd alert.
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only and should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.